5 minutes of the Leaf game under the bottom right of the PowerPoint. I am a hockey lover myself as well, but I think I'm going to be in tight to keep a Canadian audience during the last 5 minutes of the hockey game. So so if you must watch the hockey game for the first 5 minutes of my presentation, I will not fault you as a fellow hockey fan. However, I will get started with the presentation. The presentation today is all about ensuring that your home equity is working for you. I am pleased to also announce that we have a guest speaker named Taylor Steele with Integrated-Equities. Taylor is somebody that I've known basically since he's started in this career, and I'm really excited to have him talk about some of the options of investing with an exempt market dealer. And one of the things we're going to talk about is, first of all, opening up your home equity, but then what to do with access to capital. This is something that we deal with quite often in our office, and that question comes up a lot. So I'll introduce Taylor a little bit later in the presentation. But welcome, and thank you for coming out, even though the Leafs game is on. Quick table of contents. I'll be talking about using your home equity. What is a home equity line of credit? Good debt versus bad debt. The tax savings of setting up a home equity line of credit. Investing in real estate. Investing in private lending, investing in exempt market dealers, and investing in stocks, and then comparing all the options and giving you kind of a step-by-step of, first, how do you access the equity in your home, and then next step, what do you do with it, and why should you be thinking about utilizing the equity in your home. So using your equity, a home paid off is not working for you. So the reality is that other than your appreciation, there is no gain owning a piece of property that's sitting there. That means that if the real estate market is going up by 3%, then you're just making 3% on your money. Same goes for, if you own a rental property, then you're making just the cash flow and the appreciation. But there's an important thing that's called leverage, and utilizing that leverage wisely. And I usually like to say use, but do not abuse leverage. I'll talk a little bit about how to build your wealth. There's a number of different ways of doing that, but digging into the piggy bank and basically digging into your home equity in your home is one of the ways that a lot of our clients build their wealth, and that's because it's very cheap to get access to capital that's secured by your home. So what people often do is they get into the situation where they're faced with a decision to make. The decision is, do I increase my investments or do I pay down my mortgage? And what we generally recommend is that we want you to do both at the same time. So how do you do that? How do you invest at the same time as you're paying down your debts? By using a home equity line of credit. And so typically what we advise our clients to do is get what's called a readvanceable mortgage, or often known as a home equity line of credit. And this is one of the ways to minimize your taxes. And so we use this this type of product to invest at the same time as you're paying down your debt. Let's give you an example here. Let's say that you own a home worth $500,000. That means the total available credit you could access would be 80% of the property value. So if you currently have a property worth $500,000 and you have a mortgage of $225,000 secured against that property that was used to buy the property in the first place, that $225,000 is not tax deductible. So you're not writing off the taxes on that amount of money unless at some point you had borrowed it to invest. Now, what you can do is you can set up a line of credit against this property. So we often restructure debt. And in fact, step number one for most of our real estate investors is, let's see where your down payment is going to come from. Where can we access capital? And one of the most tax efficient ways to do this is to actually set up a home equity line of credit product against your home. So in this example, you get $225,000 owing in your mortgage, and the property value is $500,000, and you can get 80% of the value, which would be $400,000 in total. Then you can get that difference. So the $400,000 in total minus the existing mortgage is $175,000. And that's what we'd set up on the line of credit portion on the right-hand side of the slide. So what happens is, as you pay down the mortgage, that available credit goes to the line of credit, and your line of credit limit will slowly increase. Because you've obtained a readvanceable product where as you pay down the mortgage, your line of credit is increasing because you can always access up to $400,000 in total. So if you pay down the mortgage from $225,000 down to $200,000, the line of credit will increase by the same amount. It'll increase by $25,000 from $175,000 to $200,000. So the total combined between the mortgages and the lines of credit will always equal $400,000. Then what you're doing is you're taking this money available to you on your line of credit and you're reborrowing that money to invest. And the reason that you do this is that typically if you're borrowing money to invest with the intention of earning an income, then the income is, or the interest is tax deductible. So again, whenever you're borrowing money to invest, the interest portion of the payments is tax deductible. This is a really important key. And by the way, I'm not an accountant. I always make sure that, or recommend that you talk to your accountant to make sure that there's no reason that this particular strategy would not work in your case. An example would be borrowing money to put into registered funds like RSPs and TFSAs. The strategy does not work. So make sure that you talk to your accountant about the minor details. But it's definitely something you want to talk to your accountant about, and often talk to a mortgage broker about how much capital can I access in my property in order to be able to pull this off and do this. And so looking at good debt versus bad debt, obviously in this case, you're now dipping into your home equity in order to borrow more money and in order to ideally grow your wealth. It's important to clarify the distinction between good debt and bad debt. You want to be minimizing bad debt while using but not abusing good debt. And so here's the difference between good debt and bad debt. Bad debt would be anything that is a depreciating asset, consumer goods, in general, vehicles, although if you buy a really nice 1991 Porsche 911, then maybe that asset is going up. But in general, most vehicles are depreciating assets, consumer goods are depreciating assets. And again, certain situations like COVID have sometimes flipped this on its head, but for the most part, consumer goods go down in value, not up in value. Then you have good debt, which are appreciating assets. And so in general, real estate goes up in value. In general, stocks go up in value. So whenever you're borrowing money typically to invest, those are typically considered good debts. And then even better is tax deductible debt. And so if you're borrowing money to invest and you're putting that into an appreciating asset, now you get to write off the interest portion of the payments. And so you're lowering your taxable income and you're also owning an asset that should go up in value. Because at the end of the day, net worth is your goal. Assets minus liabilities is your total net worth. And so you want to make sure, like, what am I acquiring? Am I acquiring consumer goods? Am I putting those on credit cards? No, you want to be investing in things like real estate and building up your real estate portfolio, or investing in other hard assets, or even liquid assets that tend to go up in value, not go down in value. Another key to this as well is you want to structure your mortgage to save money in tax. And that was talking all about borrowing money to invest and ensuring that that it's tax deductible. So how does this portion work? Because it's really important to understand this. What you do is you make your mortgage payments, you reborrow the principal that you've paid down, you're investing that money, and you're saving on your taxes. And it's very important to understand that it all comes down to the use of funds. So what are you using the money for? You cannot use it for consuming or consumption. Those are not tax deductible. Buying personal goods and items are not. But if you're using the money with the expectation of generating income, that is considered tax deductible. And so generally speaking, this is step number one. You want to look at, can I access equity in my home? How much can I access? And keep in mind that, we've seen Canada-wide historic appreciation. I was at a conference today, actually, and they were saying that the appreciation that we saw in 2021 was the highest on record in Canada ever. It wasn't the highest in British Columbia. The highest in British Columbia was between 2015 and 2016. But this is the highest annual appreciation that we've seen in Canada ever, year over year. And so now is a better time than ever to be looking at, can I access that home equity, pull it out of my home, and then reinvest it and use that money to invest into something else. So what are our clients doing right now? A lot of them are reducing their payments and paying off their high interest debts by refinancing. So one of the keys is, and this is often what kind of gets connected to the step number one, in order to be able to qualify for more, if you wanted to go out and buy more real estate, for instance, it's really important that you have a nice clean slate in order to qualify for a rental property purchase. And so a lot of our clients do this where they set up a mortgage and a home equity line of credit. They actually add to their current non-tax deductible mortgage to clear off all of their high interest debts. No more credit cards, no car loans, etc. They clear all that off and reduce their overall payments by paying off all of those debts and refinancing and restructuring. They're also learning how the Smith maneuver works. And so that process of having a home equity line of credit, paying down the mortgage, and then reborrowing the money back out to invest, and having that effect snowball too, because you can actually take your income from those investments and pay down your personal non-tax deductible mortgage, which opens up more room in the line of credit, which means you can invest more funds. It's a bit of a snowball effect. And so we actually have a number of books at our office all about the Smith maneuver for anybody that would be interested. I think we probably have a couple of extras. So you'll see our email near the end of the presentation. You can send us an email and get a copy of that book. But the Smith maneuver is basically a book that was written about 20 years ago or so that discusses this core strategy of using a home equity line of credit in order to borrow money to invest. Getting access to capital to invest and earning a spread on the interest costs versus your return. We're going to talk about that in one of the next slides here. Basically, the core principle here is if you borrow money to invest, you want to make sure that whatever you're investing in will have a higher rate of return than your costs of borrowing. So if you're borrowing money at 4%, you want to make sure that you're earning at least 6 or 8% on the returns consistently to make sure that you're in the green, no pun intended, to make sure that you're making more money than what your costs are. And it's really important too to understand that in general, the residence is the hub. This is usually where most of the action happens. This is usually where people are leveraging. It's easier to get leverage against your residence. It is generally cheaper. You usually get better interest rates and better terms when you're borrowing against your residence. And in general, most of our investor clients are using their home equity to buy rental properties. In fact, what often happens is they take their extra cash that they have to pay down their non-tax deductible mortgage payment or mortgage, which opens up more room on their line of credit, which means they have access to more capital to borrow to invest. And here's the thing, you want to be making a spread. And so if I take you investing at 8% and then borrowing at a current interest rate of about 3.7%, and that rate of 3.7, by the way, is the current prime rate of 3.2, plus 0.5%. So I do expect in June that the Bank of Canada will likely be looking at increasing the interest rates. But as of now, right now, you're looking at about 3.7%. And so if you're investing at 8%, you're creating a spread on that money of 4.3%. So to give you an idea here, if you had $100,000, you've been making $8,000 on your investment, and you'd be paying $3,700 per year in interest costs. You'd be earning $4,300 per year per $100,000 that you had invested. If you invested $500,000, well, now you're earning over $20,000 per year just by taking out money out of your home equity and investing that into some other investment vehicle. And there's a lot of different ways of actually investing that money. So the question often comes up, great, Kyle, where, I'd love to access my home equity, but then what do I invest in? There's a number of different options to invest in. So I want to give everyone here just a quick overview of the different types of opportunities and ways to invest their money. You can invest in real estate, which would be buying cash flowing rental properties. That's a very common thing. And of course, most of our clients are real estate investors. Probably 80% of our clients invest in real estate. And so that's what we're very accustomed to. And this is probably the most common way of common thing to do accessing the home equity. We do have a lot of clients, however, that also invest in stocks, especially when COVID hit and early in March and April of 2020, there were a lot of opportunities to access capital in their residence to then invest in stocks at very low prices. And so you can borrow your money against your residence to invest in stocks. And there's a number of other different investments too. There's private lending. And so you could be the lender and lend to people that have difficulties getting mortgages. And I will say that that the trend has been that stronger and stronger borrowers having to go to private lending for whatever reason, because banks have become more rigid and tighter. And also private equities, which is what Taylor's going to speak about today, as he knows a lot more about private equities than I do. And he'll go into some of the details about exactly what private equities are and how you can invest in those. So first of all, the first option we talked about, which was investing in real estate. Why invest in real estate and why buy hard assets? The primary reason is actually leverage. And so when you look at leveraging, it's probably the most important aspects of investing in real estate. So let's give you an indication or an idea here. If you bought a rental property, it's require 20% down, but owner occupied, and second homes you can buy with as little as 5% down. And so you're leveraging your money in these cases. If you buy a residence, you're leveraging money 20 to 1. You're buying an asset with only 1/20th of the cash required to buy that asset because you're putting 5% down. For you math junkies out there, that's because 5 goes into 120 times. If 20% down, you're putting 1/5 of the property value down. So you're leveraging money 5 to 1. So let's paint a bit of a picture here for what are the returns investing in real estate. And in general, you make your money in real estate in 3 different ways. And so first, there's cash flow. In general, cash flow right now in most major urban markets in Canada, especially like Vancouver, putting 20% down, it's tough to even find something that that just covers itself. And so a lot of the time, this 1 to 4% return would usually be finding something in a smaller market or in Edmonton or somewhere like that, where the cash flow might be a little bit better. And so in general, most real estate investments are about a 1 to 4% return on your money from the cash flow perspective. Then there's the appreciation. So here's the really interesting part. If we assume that the annual appreciation is about 3%, and the reason I use 3% for my future projections is that in general, the banks, Bank of Canada and other large central banks usually look at trying to target inflation at about 2%. And so a lot of their monetary policy is usually revolving around trying to make sure that inflation hovers around 2%. Obviously, for all of you that watch me that have been watching the news, inflation is actually way higher than that. You're looking at like 6.7%, I think was the last piece of data. And so we've seen a really high appreciation, which, believe it or not, is also good for real estate. Mortgage rates are going up, but so is the appreciation factor. But if you had a 3% annual appreciation rate, if you put 20% down on a rental property, your return on investment from the appreciation factor is actually 15% return on your money. So if I paint a picture here, if you bought a property worth $500,000 and you put $100,000 down, that's your investment into the property. If the property went up by 3%, so went from $500,000 to $515,000, you've made $15,000 on your $100,000 investment. That would be a $15,000 return or 15% return on your capital. And so this is a really interesting thing when you're buying a rental property. You're getting a 5 to 1 return on the appreciation. So every 1% of appreciation is actually a 5% return on your money. Here's the one thing that people forget about though. And if you had no cash flow and no appreciation, if you just bought a property where the tenant covered your mortgage payments for you and it never went up in value ever, you would still get a 7.5 to 9% return on your capital by just having the tenant pay down your mortgage for you. So in the same example, buying the $500,000 property with $100,000 down, your tenant's probably paying down $7,500 to $9,000 per year on your mortgage without you having to lift a finger. And that's with no appreciation and no positive cash flow. So no extra cash is going into your jeans. And this is something that people often forget about. So here's the cool thing. You add these up, cash flow, mortgage pay down, appreciation, you're in the mid 20% for expected annual appreciation in investing in real estate, which is very high. One of the things we're going to talk about near the end of the presentation is the reason that the returns are quite high, and one of the highest that we're going to be showcasing here today is also that it's very illiquid. And so it's harder to sell these assets, which is one of its negatives. It's harder to buy a property and then sell it within a day like you could with stocks. And so, when you break it down this way, though, it's hard to refute that the returns in investing in real estate are quite good as long as you have some level of appreciation. And in general, appreciation doesn't just go up by 3% steadily every year. It usually goes up by 10% one year and then 0, -2, and then up 5% and then up 15%. And it can vary quite a bit. But if you want to look at the long haul, investing in real estate is a really good long-term play. Now let's stick with the real estate side of things. But now let's look at, instead of becoming the owner of the property, let's become the lender on the property. So let's be the bank. So what is private lending and what does that look like? You can do private lending and loans, and you can do a number of different options and different strategies here. We often do a lot of deposit loans. And so a deposit loan is when a buyer is buying a new property but hasn't sold their existing property yet, but they have to put a deposit on the new purchase as part of their purchase contract, but all of their equity is tied up in their home and they don't have access to any capital. We've arranged a lot of deposit loans, which can be fairly quick and fairly lucrative. Where we find people go to private lending quite often is people that are doing flips. And so if you're buying a property and selling it very quickly, especially if the property's in rough condition, a lot of banks will not finance those. Developments, a lot of developers actually will go to private lenders, especially if they're early on in the stages and they're not ready to break ground and they don't have a building permit or development permit yet. You'll find that private lenders are a lot more flexible. Private lenders generally are lending based off of the property and the amount that they're lending on it. So where is the property and how much are you lending on it is the general key with private lending. So they just assume that you're going to default at some point, and they look at, well, what kind of property am I lending on, and how much am I lending on it? A standard, first mortgage or second mortgage for a borrower that can't qualify with a major bank. So maybe their credit is poor, maybe they had a divorce or separation. There's a number of different reasons that somebody might not be able to qualify for a mortgage right now. And in general, private loans are all short-term loans in nature. And so in general, you're only lending somebody money for 1 year. Every once in a while, we'll see money get lent out for a 2-year term, but it's pretty uncommon. And in general, as a private lender, what you need to look at is what am I lending on and how much am I lending on it, feel comfortable. One way that I've heard somebody kind of phrase this is, if you're a private lender and you're lending 50% of the value of the property, then the question you ask yourself is, would I own this property for 50 cents on the dollar? Because if you have to go through a foreclosure event, then what end up happening is you may end up becoming the owner of the property if the person walks away from it and basically you now own the property and you put up 50% of the cash in as a lender. But now you own the property, and now that mortgage has been wiped off. So that's one way of kind of understanding, and that's where in general private lenders usually don't lend above about 75 to 80% of the property value unless they're really comfortable with the borrower or the exit strategy. So now I'd like to bring Taylor to the stage here. I've known Taylor for, geez, Taylor, I'm not sure how many years I've known you for, but it's got to be at least 8 years or 9 years, something like that, I think.
Thanks a lot, Kyle. Great to be here. Yeah, coming up, I think close to 10 years. Been in the business now, coming up on 7 years, and was involved in the Reit community while still in university there. So coming up close to 10 years, it feels like.
That's awesome, man. And Taylor, I know I have wonderful hair, but Taylor actually has much better hair. I'm not sure if you're going to be able to show us your beautiful hair tonight, Taylor. But that if you're not, then that's really, really, really a shame.
It says unable to start video because the host has stopped it. So
whoa, it's my fault. It's my fault.
Want them to see.
Okay, here, let me make you co-host, and hopefully that will allow you to share your screen then. There we go. There it is. Perfect.
Good stuff. Right. Great to be here, and great to see so many familiar faces here within the chat. And for me, myself personally, Kyle was my mortgage broker who helped me purchase my primary residence back in 2016, and actually just last month refinanced my property and set up the home equity line of credit. So for me personally, I'm looking forward to deploying that strategy into my portfolio. And thanks, Kyle, for having me on today to talk about private equity investing and exempt market dealers and what they are. So today I'm going to be talking about how investors are adding private equity to their portfolio. I'll be discussing the benefits of private equity investing, how it can provide your portfolio diversification, who's eligible to invest in private equity real estate, and the key characteristics of investing in private equity. I'll also be sharing 2 of the different investment companies that we work with, helping our clients invest both in Canadian multifamily and US multifamily. So a presentation wouldn't be complete without a risk disclaimer. So this presentation is for informational purposes only and does not constitute a solicitation or intend to be a solicitation. These investments are offered by an exempt market dealer, Integrated Equities. And with any investment, there are risks associated. It's important to review and understand these risks before making any investment decisions. So next slide, please. So what is an exempt market dealer? I think the term that a lot of people hear is EMD, or exempt market dealer. And these are firms that are set up to offer private equity investments. So what a real estate brokerage is for realtors and clients in that capacity, an exempt market dealer is a brokerage that's set up to be the agency between the client and the investment companies that the clients are making those investments into. And so the firm is set up to offer private equity investments, and that can be in a number of different categories. You can make private equity investments into technology companies, into mining companies, into cannabis companies, but our firm is specifically designed to help our clients invest into private equity real estate deals. And so what our job is here is our company is called Integrated Equities. We're an exempt market dealer licensed across 4 provinces here in Canada: BC, Alberta, Saskatchewan, and Ontario. And what our job is to find companies and deals for you to invest in. So what we do is we do our due diligence on these companies. We understand who the management team is that's going to be operating these deals. We research the markets, understanding the economic fundamentals such as job growth and population growth within those areas. And we also underwrite and analyze these deals before bringing them and taking them to our clients. At Integrated Equities, we focus on finding experienced management teams, each with a strong track record, and they're focused on a specific investment strategy. So we're not out there looking to work with startups. We want companies with a long track record of saying what or doing what they say they're going to do, and each with a narrow niche specific investing strategy. So not a company that's in 3 different countries doing multifamily, commercial, retail. We want each one to be very geographically focused and asset real estate focused as well. So who can invest in private equity? I think for a long period of time, private equity was reserved for what people think of as the big boys, big, tall offices, guys in blue and black suits. If you've ever seen the show Billions, you've got a bunch of really smart people around a boardroom. And in some capacities, private equity is that. But for the everyday investor here across Canada, I think the barrier to entry has really decreased, and it's allowed more and more people to participate, everyday investors from across Canada. And so today, private equity is open to both eligible investors and accredited investors. And so a quick overview of an eligible investor is someone who makes $75,000 a year or more of income, or who has $400,000 of net assets, including real estate. So those are what qualify someone as an eligible investor. What makes someone an accredited investor, the 3 common qualifications are: they make $200,000 a year or more of income, they have $1 million of liquid net financial assets, or the third is $5 million of total net assets, including real estate. So those are the 2 categories of investors. You've got eligible investors and accredited investors. Some projects are restricted to accredited investors only, and some are open to both eligible and accredited. So these private equity investments are designed to provide a passive, hands-off way of investing in real estate. These companies are set up to research the markets, acquire the properties, set up the mortgage financing, operate and manage the deal, and sell the property on your behalf. And you as an investor provide the equity for these projects and sit back as a passive, hands-off investor. Next slide. So some of the pros and the cons of investing into private equity real estate. The first, as I mentioned, it's a passive, hands-off way of participating in real estate. The second is there's no mortgage financing required. So if you make an investment for $25,000, you don't need to go and personally arrange any mortgage financing. So this is great for people who either can't qualify for any more mortgage financing, or at a point in their investing career where maybe they don't want to get any additional mortgage financing. So you as the investor don't have to arrange that. The third pro of investing in private equity is the minimum investment is low at $25,000. So if you have $100,000 of capital that you're looking to participate, you could diversify that across 3 or 4 different projects, providing some diversification both in geographic areas. So you could have some here in Canada, some in the US, you could have some in multifamily, you could also have some in commercial real estate. So the ability to really provide your portfolio with true diversification. And then the pro of investing in private equity is a lot of these companies are set up to accept registered accounts such as RSPs and TFSAs, and this is done through Olympia Trust. So if you do have any registered accounts that are sitting there, you're maybe not happy with the return that you're currently owning, Olympia Trust is the financial intermediary that acts between the developers and the investors to allow these investors to use their registered accounts. Taking a look at maybe some of the downside of these investments, private equity is considered illiquid. With your stock portfolio, you could wake up tomorrow and say, hey, you know what, I want to sell 50% of this, and you can put in an order to sell your portfolio. Generally, private equity investments are illiquid. You're expected to be in the project for the duration of the time. And so from that standpoint, they are considered to be illiquid, and the projects can take longer than expected to exit. So with those features, with the time period and the illiquidity of it, the Securities Commission deems these investments to be considered a little higher risk. And so Now I'm going to touch on some of the multifamily groups that we've worked with here through Integrated Equities and what these companies are up to in the multifamily space. So the first group is Centrion Apartment Reit. They're one of Canada's largest private real estate investment trusts, and they invest in apartment rentals and student housing across North America, specifically majority focused up here in Canada. And today they've got over 102 properties with close to 15,000 rental units. So as an investor investing in the REIT, you're getting diversification across 102 properties, over 15,000 rental units. Some of their most recent acquisitions include Langford over on Vancouver Island there. That's a market where they have a number of buildings, and it's a market that they continue to like. The second one was Kelowna. They purchased over 250 units up in the Kelowna market for rental, and then as well as Montreal, Quebec. So those are some of the recent cities that Centrion has acquired properties in. So as an investor, you're getting some exposure into those markets. Again, touching on companies with long track records and experienced management teams, this company's been in business since 2009. And since then, they've averaged just over a 13% annualized return for their investors in the REIT. And today they target between 7 to 12% annualized returns. And this product has a monthly distribution component to it. So as an investor, you're seeing monthly distributions holding the Centrion Apartment REIT. Next slide, please. And then the final group is Western Wealth Capital. So Western Wealth Capital is actually a North Vancouver-based company. We've worked with them since their inception in 2017. And what they do is they buy existing apartment buildings down in the United States. So they buy 1980s, 1990s apartment buildings where they can renovate, increase the value, manage, and then sell between a 3 to 5 year period. To date, they've acquired over 120 properties with over 27,000 apartment units. The cities that they like are Phoenix, Dallas, Houston, San Antonio, Atlanta, and Las Vegas. So as an investor, you can piggyback off this company, providing your portfolio some diversification into the US multifamily space. Their track record has been quite strong since 2014 on the properties that they've purchased, renovated, and sold. They've averaged a 30% annualized return on those exited properties, with their lowest performing properties that they've sold being at 11% annually on those exits. Their current project is in Phoenix, Arizona. It's available to accredited investors only, and they're targeting a total annualized return of about 16% on that property. So with Western Wealth Capital, they target a 3 to 5 year exit on these particular properties. And with the Centrion Apartment REIT, they have both a 3-year hold and as well as a 5-year hold. And so if you guys would like any information on these private equity investments, if you want to send Kyle Green an email saying private equity, he'd be happy to connect us, and we'll make sure to get you guys all a link to our investor portal, as well as some investment packages for you guys to review. And then I'll just jump to the next slide here. And I'll pass it back to Kyle here, but one of the final benefits of private equity, as I mentioned, is the diversification aspect, the low entry to participate, and as well as the fact that you can be a small part of a big deal, and you get to participate in real estate, in investments backed by real estate with a very passive, hands-off approach. So thanks for the stage here today, Kyle. Appreciate the opportunity to educate people on private equity, some of the benefits and how they can participate here.
For sure. Yeah, thanks, Taylor. That was really insightful. And by the way, Taylor will stay around for a few minutes after the presentation is over, just to answer any Q&As. And so just make sure you put any questions you have into the Q&A section or the chat, and then we'll make sure that we get those answered at the end of the presentation. So I think in general, the thing that I look at when you're looking at an exempt market dealer is, in general, you're investing in a strong company that has a really strong niche, as Taylor was mentioning, that is doing a bigger deal than in general most of you would be able to do on your own. And so that's the advantage, as well as just not having to do things like go get a mortgage. I'm a mortgage broker, my team does mortgages, and we know how painful getting a mortgage is. And so sometimes it's nice to just get access to a home equity line of credit. You just do one mortgage, and then you're just cutting checks, and you're just investing your money and letting other people take your money and do everything that they can with it to build it and grow it. So of course, another option is you can always invest in stocks too. Lots of different ways of doing that. Let's take a look at some of the people that have invested in stocks and see how they did in the last couple of months. I'm just kind of curious how all these people have done. Oh, that guy did really, really well. I guess he was shorting the market. And this person, oh, not so well. Okay. Or you can invest in real estate, sit back, relax, and watch your investments grow. It's up to you. You can invest in stocks, you can invest in other things. One of the nice things about investing in real estate, in whatever way that you invest in real estate, is that it's a bit more of a passive investment. You're not watching it every single day and really having to micromanage it. It's a little bit more of a longer term play than stocks. And so, which do you choose, and how do you choose from all of these different investments and the different options that you can be looking at? I created this slide as a bit of a chart here to just go over some of the differences and the key things that people are typically looking at that differentiate what buying real estate is versus private lending, investing with an exempt market dealer, and investing in stocks. And so the first thing that's important is qualifying. So if you're purchasing real estate, there is a qualification process. With private lending, there's no qualifications necessary at this time anyways. And we're hearing that there might be some qualification coming down the pipeline at some point in the future, but as of now, to be a private lender, you do not need to have any qualifications. To be investing with an exempt market dealer, there are some qualifications as Taylor had laid out. There are different ways of who can invest in an exempt market dealer. And investing in stocks, you don't really have any qualifications there either. Average total return on investment, in general, most real estate deals are about 20 to 30%. So somewhere in that mid 20 range is kind of the expected target there. Some deals will make you a little bit less and some deals might make you more, but in general, your average total ROI is about 20 to 30% investing in real estate. Being a private lender, it's usually about 6 to 12%. And that depends on whether you're a first lender or first mortgage holder or a second mortgage holder and how risky of a deal you're lending on. Exempt market dealer, you can look at 7% to 20% as kind of a good range to expect. It's really hard because these exempt market dealers, like Taylor's trying to hold back and not talk about how they think they're actually going to be able to achieve on some of these deals. Like they're mentioning their track record. I think the lowest that they've ever had was 11%, and in many of their funds with Western Wealth in particular, I think there was closer to 30%. So at the end of the day, it's hard to know exactly how an exempt market dealer return will look, but in general, good kind of range or target, 7 to 20%. And stocks, in general, 5 to 10% if you're more of a value type of buy and hold, or if you're investing in a fund or a mutual fund or something like that, then in general, you're looking at between 5 to 10% as a reasonable expectation. Now, if you're buying real estate, the cash flow component of the return is only 1 to 4%, whereas with private lending, it's all of the return. Well, when you're a lender, you're just making the payments and the cash flow that you're earning on that. And so not a lot of it's coming from cash flow. In general, with an exempt market dealer, it depends on the type of investment you're investing in. Taylor can go into more detail, but some of them are going to be a bit more of a cash flow play. Some of them are going to be more of an appreciation play, but in general, looking at between 0 to 5%. And then stocks, generally the cash flow is between, probably could have actually said 0 to 6% here, because in general, you're not usually getting a lot of cash flow from your stocks. But if you're buying dividend stocks, as an example, specifically, then you're probably looking at between 3 to 6% if you're buying dividend stocks. The term of the investments, but purchasing real estate generally is 5+ years. Yes, you can flip real estate and whatnot, but in general, we usually recommend if you're buying real estate, you're usually looking at it from a long-term picture here, as opposed to a short-term picture. Private lending, you can lend and be a lender for only 1 year. That's usually the likely term, and then you as the lender actually have the ability to decide if you're going to renew or not renew that mortgage. So it's kind of up to you. Being an exempt market dealer, the term of the investment is generally between 3 to 7 years. So again, just depends on the nature of the deal. And stocks, you can be in it for 1 minute or 1 lifetime. Really depends, and it's kind of up to you. So stocks can go in many different directions. There's many stocks that Warren Buffett has owned his entire career and will not sell. And so you're going to look at all these timelines and term of the investment definitely varying for sure. The payout frequency also varies. So in general, with purchasing real estate, you're looking at about a monthly cash flow if there's cash flow, and then most of the payout is upon refinancing or selling the asset. One really nice thing about the real estate is you can hold it for a long period of time and then you can refinance it, and all that cash comes out of the property tax-free. So you're not paying any capital gains or any taxes until you actually dispose of the asset. With private lending, in general, if you're the lender directly, you're usually getting a monthly payment. If you're investing in a MIC, a mortgage investment corporation, or some other fund, then sometimes the payouts are only quarterly or annually. But in general, if you're the actual lender, your payments are based on a monthly basis, and so you're getting monthly checks. With an exempt market dealer, the payout frequencies sometimes are monthly, sometimes are quarterly, but they're often at the end of the term, and that really varies again on the type of investment that you're making there. And with stocks, if you invested in a dividend stock, then generally those dividends are paid out quarterly. As far as volatility is concerned, in general, we'd say that the real estate is probably medium. The real estate values can definitely go up and down and whatnot. Private lending is generally considered fairly low risk as long as you're doing low risk lending. Investing with an exempt market dealer is generally between low to medium, depending on the type of investment you're making. And the volatility investing in stocks is rather high. So, stock markets can go up or down 5% in one day. Real estate, if it went down up or down 5% in 1 year, would be considered a reasonable swing, but yet stocks can do that easily in just 1 day. And so definitely a lot more volatility in stocks. As far as liquidity, it's almost the inverse here. So liquidity in real estate is quite low. It obviously takes a lot longer to sell a property. Private lending, I would say it's medium. It really depends, judging by how much volatility you would consider as being medium. That could be, if it's a 1 year term, you might say, that's fairly liquid. Some people might view that as not very liquid. And so I would say the private lending kind of falls right into that medium category. An exempt market dealer, in general, the liquidity is quite low. A lot of those deals are a bit more locked in, and so you're usually in it and you're riding it out until that deal has been sold. And then stocks, the liquidity is quite high. One important feature here with purchasing real estate is that the actual purchasing real estate, without getting quite complicated, there is one way of technically lending your RSPs kind of to yourself, but it has to be an RSP swap, and you can buy real estate that way. But in general terms, like 99.999% of real estate is not real estate eligible or RSP eligible. Private lending, however, is. You can self-direct your RSPs through Olympia Trust or Canadian Western Trust, and you can actually lend out your RSP money, which is nice. Exempt market dealers, often their products are usually RSP eligible as well, or a lot of them are. Not all of them are, but it seems like most of them are. And then in general, most stocks are also RSP eligible, but again, some are not. So it really depends on the situation. But for the most part, all the yeses are going to encompass most of the varieties. Now, one important thing here is it's important that whatever you do invest in, you have some diversification. Although I am very biased, and I firmly believe that investing in real estate will give you one of the highest returns and will be the best ways to building your wealth. It's really important still, if you're investing heavily in real estate, to make sure you have some diversification. You don't want to be super heavy in real estate and only own properties, and then all of a sudden you have a liquidity problem and you don't have any liquid assets, you don't have any stocks, you don't have anything else that you can easily liquidate to just weather the storm. And so we generally recommend that you build your real estate portfolio, but also do other things to make sure that you're well diversified and have different strategies. And speaking of that, it's really important to get your retirement strategy in place if you don't already have that. It's important to figure out and start to think about, like, what do I want to invest in? Maybe if I have been paying down my mortgage for quite a while now, maybe it's now a good time to start to look at accessing that capital and then reinvesting it into something else and creating a spread on the money. We have a lot of different things available on our website. We have our investor survival guide on our website, a private lending package. If you want to learn more about private lending, is available on our website too. FAQs. Our next webinar is on June 1st at 7 p.m. It's always the first Wednesday of every month at 7 p.m. And that webinar will be how to buy your first 5 properties. We want to talk about the step-by-step way of building a real estate portfolio and buying your first 5 properties, and which lenders to use, which lenders not to use, how do lenders qualify you, what are some of the things you want to start to think about when you're buying your first 5 rental properties. If you have any questions, you can always book a consultation with us today. And if you did want a copy of the Smith Maneuver book, please just send us a note, and we'd be happy to send you over a copy of the book so that you can read through that if you wanted to learn more about the specifics. There's a few tax strategies that I did not go into today. I actually did do a webinar about that earlier this year, either in January or February, that went into more details about the specifics of the Smith Maneuver and a couple of other more complicated strategies and concepts. Also, I'm a best-selling author. I wrote Rockstar Real Estate Investing, and anybody that does not have a copy of that book, please let me know, and we'll be happy to send you a copy of that book. If there's any questions, then please reach out. Our email is info@greenmortgageteam.ca. If you wanted to learn more about private equities, you can send an email to info@greenmortgageteam.ca, and we'll be happy to connect you with Taylor, so you can have a chat there. And now maybe what I'll do is I'll open it up to the Q&A just to go through that and see if we have any questions. Bo asks, just joining and wondering if this is being recorded. Yes, and so Bo, the recording will be emailed out to all of the people that had registered for this, and so you will get a copy of this once it's done. And it looks like Taylor, you've been hacking away and answering a bunch of questions. That's awesome. Perfect. All the questions are for you, Taylor. You're stealing the spotlight. That's great.
Or I didn't do a good enough job explaining it, and then that's why they have the follow-up questions, whereas you just knocked it out of the park and answered everything in one go.
Yeah. So we will be sending out an email. If you received this email for this webinar, then we'll be posting the sign up on our website shortly for the upcoming webinar. And maybe what we'll do too is when we send out the email with the recording, we'll pop in some more information about the upcoming webinar on June 1st as well. So thank you for asking that. Adele has a question. So what are the tax implications to Canadians when investing in the US investment? Maybe I'll answer it from the buying real estate side, and then Taylor, I'd love for you to jump in and talk about that from the exempt market dealer side. So the tax implications to Canadians when investing in a US investment, they are complicated. You need to make sure that you look into the cross-border tax accounting. There's a number of different ways that you can do that. You can set up an LLC or LLP down in the US, or you can buy it in a personal name. In general, when you're buying across the border, you're now having to file taxes down in the US and in Canada, and there's cross-border taxes that are rather expensive to look at. So I know that some of our clients do own a few properties down in the US, and I think anywhere from $2,000 to $6,000 is a reasonable expectation on what the cost of filing the taxes are. And Taylor, I'm sure you can elaborate on that a little bit more, but there are some implications, at least when you're buying real estate down south. But Taylor, maybe you can elaborate a little bit more about, because Western Wealth does a lot of stuff down in the US. What are the tax implications if you're investing in an exempt market dealer that does that down in the US?
This question comes actually at a really good time, and I'm just looking at an email here from my accountant, and me and a buddy of mine are looking at an Airbnb property down in Scottsdale, and we're talking about different kind of ownership structures. Do you purchase it personally? Do you purchase it through a holding corporation? Do you set up a C Corp in the United States? So these are kind of 3 levels of structure to invest, and I'll read the answer here. So. Spoke with the U.S. tax advisor, and he mentioned that ideally you invest personally rather than through a corporation. The tax rate on rental income is 54% and capital gains 27%, assuming top marginal rate if you invest personally. Investing directly with your corporation, the tax rate is 67% on rental and 39% on capital gain, assuming a 5% state tax. And investing through the C Corp, the tax rate on rental income is 54% and 54% on capital gains. So those were some of the metrics that they provided. And I'm happy to forward this email here. Again, this is not my tax advice. Please don't hold me to it. I'm not an accountant, especially a tax accountant, but just wanted to share the information that I received. And on the other end of the coin there, taking a look at Western Wealth Capital, they set up limited partnership structures for these investors to participate. So as a Canadian investor, you're investing through a Canadian limited partnership. The tax obligations when investing down in the US as a limited partner, you are required to file both a state tax return and a federal tax return. We work with a great cross-border tax team, and happy to pass along some names and recommendations for these groups, but they handle all the state and the federal tax filings on behalf of the clients, hand them their T5013 and their K1 to provide to their Canadian accountant. So those are kind of some insights on the US tax structures.
Thanks, Taylor. I've got another question from John. So explain what syndication are and their risks. So if you're probably asking this question with regards to private lending. So syndication means that we have multiple different investors investing in that loan. And so syndication means more than one lender effectively. And in that type of situation, you just need to make sure that you and the other people that are doing that loan don't have other differing opinions on what your objective is with that loan. It's kind of like a joint venture in that sense, except you're the lender instead of the owner of the real estate. And in general, usually your plans are more aligned if you're doing a lending deal as opposed to an investing deal when you're doing a syndication. But if you're doing a syndication, let's say that 4 of you lend on a loan, and then it comes up for renewal and 3 of you want to renew it and the other one doesn't. Well, now you need to figure out, are you going to replace that one person or only offer a smaller renewal to the borrower that may cause them to not want to renew and to change lenders, et cetera. And so in general, it just makes sense to have in a syndication situation to have less people that that may not have goals that are aligned. So that's something to take into account. There is also from what we're hearing, I haven't seen it yet, but we're hearing there's a lot more rules and regulations maybe coming down the pipe with regards to syndicating mortgages in the future, effectively just trying to move that away from the mortgage broker domain and going more into a security, because really if it's you and a group of people lending on property, then that may be viewed as security, which then would be managed by the BC Securities Commission instead of BCFSA, which handles the mortgages. Gave us a question. I have my mortgage renewal coming up. Refinancing is as good as HELOC. So HELOC is a type of mortgage product that you can get. And so if your renewal is coming up, it is a good idea to then look at your existing mortgage amount that you owe. You keep that as the mortgage amount. If you have any debts that you need to or want to roll into it, then you increase it to pay off all the debts. And then you're going to add a line of credit behind it for as much as you can qualify for, to then have that money accessible to you to then borrow to invest for future deals. And so if your mortgage is coming up for renewal, it's actually a great time to be looking at that. In general, lenders will hold rates for up to 4 months. And so if you're 4 months in within the renewal, then now is a great time to be talking with our team to look at what kind of rates the current lender is offering, what kind of product the current lender is offering. Not every lender has a home equity line of credit product, and certain lenders have different, there's small little nuances about the product. So it's important to understand all of those. So Gabe, feel free to reach out to our team if you want to learn more about that. Williams has a question. Please comment on the risks of HELOC and increasing interest rates. So that's a great question, Williams. There's obviously a lot of upward pressure with regards to interest rates. I've actually been at 2 conferences back to back this week, and there's been an economist speaking at each conference. And it seems like that the June announcement will probably see about a 0.5% increase to the Bank of Canada's overnight lending rate, which means that the prime rate with the banks would then go up by a 0.5%. So anybody in a variable rate would see their rate go up by 0.5 point. One of the considerations here is that if you are borrowing money to invest, we really like lenders and products where you can have multiple different tiers inside of it. So not just one mortgage and one line of credit, but actually can break that line of credit into multiple different components. So the advice to a lot of our clients actually is, if you had a $200,000 line of credit and you borrowed $100,000 to invest and buy a piece of property with it, and you expected to hold it for more than 5 years or 3 years or whatever, we generally recommend, hey, why don't you lock in the 100 grand, into a mortgage term. You can actually have that as a mortgage rate. So you can go with a fixed rate if you're worried about increasing interest rates. You can go to the closed variable, which is a lower interest rate than an open variable, and so you can cost manage that mortgage now. The key though is you probably wouldn't want to lock it in if you're doing a flip, because if you're doing a flip and you're planning on selling it in 6 months, and you want to be able to pay off that line of credit, which is open. There's no penalty to pay off that line of credit. Where if you lock it into a mortgage, now there's a penalty to break it. So generally recommended that any money you're borrowing for an extended period of time, you consider locking it in and getting a lower interest rate on it. That's where if Taylor's offering a product that you're interested in and its expected time frame is about 5 years, then you may consider locking in the money you've borrowed to invest in for 5 years, and now you know exactly what your costs are going to be to make that investment. Taylor, I'll let you answer the next one that Williams has here.
Yeah, so the question is, why coordinate with you? Why not go directly to Western Wealth or other syndicator? So the reason why we're set up to act in between the middle of the investor and the developer, such as Western Wealth Capital, is to really determine investment suitability. We have a duty on behalf of the client to make sure that these investments that we're putting them into is suitable. And so for a lot of these companies, they don't have their own exempt market dealers set up internally. So for them, they have to work with third-party exempt market dealers as requirements by the Securities Commission to make sure that the deals that we're putting the clients in are suitable and make sense for them. The second component to that is why work with us is generally with these companies, say it's a $10 million raise. They've got 20 teams from across Canada. They're going to help them raise this $10 million. So that's $500,000 per team set aside on average. So each team has a set allocation that they can get their clients into that particular project. So for us, the second reason why people work with us is access to these opportunities. So access to these developments with a specific time shelf on them. Using our allocation that our team has reserved for our clients, we're able to put them into those investments, deeming the investment is suitable and makes sense for them. So those are some of the reasons why investors work with an exempt market dealer.
Thanks, Taylor. I think one thing I've heard too is that it's like if the developer wanted to go the route of becoming an exempt market dealer, it's very difficult for them because they'd be only raising capital for themselves, which then there's a lot more scrutiny about the fact that if they have people coming to them wanting to invest with them, they only have one offering. And how do you possibly align suitability if you only have one offering and not multiple offerings, right? Awesome.
Exactly.
All right, Steve has a question. I have a decent sized property with my primary residence. Can I use a HELOC to build a new primary on the same property while living in the existing? Yes, you can. In fact, doing construction and doing a build, that's generally recommended. It's much cheaper and easier for you just to set up a HELOC on your current property and then utilize that to fund your build, because then you're only using the money in the HELOC as you build it and grow it. And you can do that while you're living in the existing one too. So it's generally easier than doing a construction mortgage on the new purchase, because construction mortgages usually have a few more requirements, and also you're only getting the money from the bank as you reach new milestones. And every time you reach a milestone, you have to then prove that you're at this milestone and get an appraiser to come out, et cetera. And so if you have enough equity in your home to just get a whole huge home equity line of credit that would be used to fund your entire project, much cheaper and easier to do that, assuming that you qualify, of course. Adele, thank you. Another question. If I have a HELOC of say $400,000 and the Bank of Canada continues to rise, would it make sense to move some HELOC into a mortgage at a lower rate? Do most banks offer this? Most banks do offer you to have a certain number of portions inside of the product. So different lenders will vary from like CIBC is only one mortgage and one line of credit maximum, and that's it. Some lenders allow you to have 3 mortgages and 3 lines of credit. Some are 5 and 5, some are up to 10, some are 99. And so it really depends on the lending institution. But different lenders allow you to have different tiers and amounts. The question of whether to lock in today or not is a good one. In general, most of our clients still like variable, but they're going into a closed variable, which is going to be a prime minus mortgage instead of prime plus line of credit. So a lot of our clients are instead going with prime minus mortgage because of where the interest rates are right now. And riding it out. But at the same time, too, if you're nervous about interest rates, then you could lock it into a fixed term assuming that the bank has that capability. Eric has a question. Did you say that HELOCs are not eligible to be put into a TFSA? I was thinking of doing that and then private lending with you. So the only key is you can use the money and put it into a TFSA, but if you borrow the money against the line of credit and then you invest the money into a registered fund, so not an unregistered, but into a registered fund, then my understanding is that the government does not allow you to then write off the interest portion of the payments, because you're double dipping a little bit on the tax savings. You're able to write off the interest, but then also because you put it into an RSP, now you're not paying any tax on that income that you've pumped into the RSP. Also, if you put it into a TFSA, then you're double dipping because now you don't have to pay interest on any gains inside of the TFSA. So my understanding, and I would clarify this to the accountant, is that if you're borrowing money to invest and you want to write off the interest portion of the payments, but you're putting the money into a registered fund, I do not believe that you're allowed to claim the interest deduction there. Awesome. I don't know if I see any other questions. Any other questions before we end the presentation? You guys are taking it easy on us. It's barely past 8. Awesome. Well, Taylor, thanks so much for coming out. It was a pleasure to see you again. And I had one more question that just came in. Explain equity syndication. Do you know what? Is that something that would be in your wheelhouse, Taylor? Do you know what that?
Yeah, so the limited partnerships that they do down in the United States, they'll set up a limited partnership and they'll syndicate the capital. So as Kyle mentioned, the multiple different partners or equity partners in the property. So they could be raising $15 million US, and there could be 150 individual investors that have syndicated that partnership together and move forward with that project. And so equity syndication is essentially getting a number of individual investors within a project.
Got it. Perfect. All right. Well, thanks for coming out, guys. Really appreciate it, and looking forward to seeing you on the next one. And thanks so much for coming out, Taylor. Really appreciate it.
Thanks for having me. That was a lot of fun.
Yeah, for sure. All right. Thanks, everyone. Have a good night.
Good night, everyone. Great to see everyone.